I just want to hand over the floor to our really distinguished panelists who do not need any introduction at all. So, we'll have Jagjit Chadha, who's the director of the National Institute of Economic and Social Research, who will chair the panel. And our panelists are Hanno Lustig, who is the Mizuho Financial Group Professor of Finance at Stanford University, Ricardo Reis, the Phillips Professor of Economics at London School of Economics, and Silvana Tenreyro, who is also professor at the London School of Economics, but is also an external member of the Monetary Policy Committee of the Bank of England. And so without further ado, I give the floor to you, and I look forward to the panel. Thank you very much.
Thank you very much, Francesca. I love it when someone does your job for you. It's absolutely wonderful. An absolute pleasure to be here this afternoon for lots of reasons, not only the distinguished panel to my left, and also the discussion we're about to have. But I have to start with the lovely observation that the weather has been absolutely wonderful today. England have won a test match with one of the highest ever fourth innings run chases in their history, and the winning runs were scored by 2 Yorkshiremen. It just doesn't get better than that. It just does not get better than that. Absolutely wonderful to start with that. I realise very few of you may know what cricket is, but there we go. Nevertheless, I'm going to enjoy the moment. But I say that purely because in the same way that these 2 Yorkshiremen mastered the field of batting, we have 3 people here who master monetary economics between them, and it's an absolute pleasure to have each of Hanno, Ricardo and Silvana here today. I think the only thing that Francesca missed was I think you're also president of the European Economic Association.
I was.
You were. Okay, forgive me. A little bit out of date on that. But I also want to thank, if I may, David Aikman, Reis and Francesca for arranging a wonderful conference. The previous session was also quite excellent. I think what we'll do is we'll run through some questions related to the exam question, monetary and fiscal policy interactions. We've been told we must finish in about an hour from now, so with about 20 or so minutes to go, I'd also like to ask the floor for their questions. I heard some brilliant questions in the previous session that are probably much better than any that I can come up with. So please think about those as you listen, and I'll be, hopefully, are there people with microphones to come round and grab people? And when you do ask a question, I'm sure we all know who you are, but just tell us who you are. Be nice to know where it's coming from. I think, just to be clear for Silvana, I think there's probably press in the room as well, so yeah, so you know that as well. So behave yourselves, I think is the appropriate response when the press are around. So the first question I have is to the panel, but we'll take it in order. We'll start with Hanno, go to Ricardo, and then back to Silvana for the first question. And I'll try to randomise it as far as I can. And so the first question is, what have you learnt about monetary policy as a result of the COVID crisis? And I'm going to ask you to answer that in a couple of minutes only.
Okay, great. Well, thanks for having me.
Not at all.
I think, speaking personally, what I've learned from the past couple of years is that models we work on in academia and economics really matter more than I thought in central banking, in the following sense. Central bankers aren't really born knowing what the right model of the world is. They're, like the rest of us, sort of trying to learn what the right model of the world is. And in a way, they're kind of groping around in the dark, learning from new data. And what we've seen in the past couple of years is sort of a robust change in the model that central bankers were bringing to bear when they're thinking about these questions in light of new data, understandably. And I'll talk mainly about the Fed. So the Fed, in 2020, sort of had a reevaluation of its policy framework, and they basically sort of signaled that they thought that in the past they'd perhaps stepped on the brakes too quickly, and that they'd made mistakes just looking at their econometric models, and that they were going to try and avoid that in the future. And so they signaled that they'd be willing to let inflation run above target for longer. That perhaps they'd be willing to let the unemployment rate go lower for longer. And they were also sort of changing the terminology. Instead of talking about deviations from the natural rate, they were talking about shortfalls of employment from the maximum rate. So there's really a robust change in the view in the policy view, in the model, the reference model that the Fed signaled it was going to use. And that reminded me of a book that Tom Sargent wrote on the conquest of U.S. inflation and the inflation in the second half of the 20th century. And this is exactly the narrative he tells, one in which policymakers, unlike in sort of the neoclassical rational expectations paradigm, they're kind of trying to learn what the right model is, and he thinks that's the right narrative, not sort of the Lucas narrative, where they just sort of happen to know the right model. And Sargent concludes his book, which I think is sort of prophetic, by saying, I hope I'm wrong about this, because if this is the right way to think about central banking, if they're sort of constantly trying to tweak their model in light of new data, then of course the danger is that at some point they'll be convinced that in light of new data that there's a more favorable trade-off between inflation and unemployment. And then the conquest of inflation will sort of prove to be transitory in some sense, right? And I think that's partly what happened. So what I take away from the past 2 years, and I'll round up, is that that there's a lot of drift in models, which I wasn't really fully aware of before that, more than I thought. And that's perhaps another reason why we should sort of think more, we used to think about this, but think more about rules versus discretion, but from this new perspective, not just in terms of central bankers who sort of know what the right thing to do is, but they can't bring themselves to do it. They're always tempted to do something else, but just central bankers who occasionally wander pretty far away from the right model. And by the way, I'm not claiming that I would know what the right model of the world is, but it does seem like we've ended up in a place where we're pretty far from where we ought to be objectively in terms of, for example, where interest rates are, where inflation is, say, in the Eurozone, to take one example. I'm from Belgium, inflation rate's 10%, and interest rates are stuck at 0. I'm not a historian, but I think that's almost unprecedented. So we're kind of at a pretty remarkable place, and the question is, how do we get here?
Thank you very much, Hanno. It's a drift. Drift is the summary of that, I think, and it'll be interesting. It's not, of course, unprecedented, unfortunately, but it is something that we'll have to wrestle with. Ricardo, what have you learned about monetary policies?
I would start a little bit just like Hanno started by looking at the mission review. I think when the Fed and the ECB, not the Bank of England because it does so more regularly with its remit evaluations, but the Fed and ECB had this very clear, let's think about how we would do things differently now from 2020 roughly onwards. 2021 the ECB. And I think a unifying thread in those mission reviews, and one that really permeates across the different dimensions and suggests that come from that, is a belief that we live now in a world that I will summarize as a low R-star world. Why? Because not only that was used intellectually to support the mission reviews, but because it really pervades the whole mission review. For instance, pick the 2 points that Hanno made. A desire to have positive deviation of inflation from target on an average. Why? Because in a low R-star world, the fear was that we'd be stuck in a deflation trap. Given that deflation trap, we want to promise to have high inflation in the future to escape those deflation traps. Or that we should start looking not at maximum employment, but have a broader view of it. Well, because if you're at a zero lower bound, you're in a secular stagnation world where demand is well below repressed oversupply, so all multipliers are very big, whether it's monetary or fiscal policy. Generally, this fear of the deflation trap, these large multipliers, more generally to a tolerance of inflation, which again permeates emission reviews, where the real fear is that inflation is too low. Having it high, good thing. And so you see, I think that when I look at the policy, let me be bold, mistakes, or at least some of the options in 2021, they reflect this. When inflation is rising, good, that's to be welcomed. It won't go much higher because we can always bring it down. Bringing it up, that's what's hard. Inflation going up, great, that's coming with a very flat Phillips curve. We're gonna get huge multipliers out of this. Deflation trap is in the past, wonderful. Even if inflation goes to 4 or 5, that just is a conquest. And if anything, not to worry too much. After all, we had inflation at 1% before. But of course, the 4% high inflation became 10% high inflation, the multipliers disappear, the Phillips curve turned out vertical very quickly, and in the end, what it seems is that this low R-star world was maybe not such a good describer of, I think, the data. It's certainly not a good describer of the world the last 12 months, and points to perhaps what led to both the cause of some of the events of the last 12 months, as well as some of the barriers that we're having in reverting that. So what did I learn the last 12 months? Low R-star, ZLB papers. I see some people here who have written some wonderful papers. They're great intellectual exercises, but maybe we believed in those, and falling on Hanno, maybe we believed those models just a little bit too much. They weren't quite as good guides for policies they could have been.
Okay, so our view on our star may have to be revised, it seems to me. Give us a whole bunch of new papers to think about, I think. Silvana, what have you learned?
Over the last couple of years, I'd like to highlight two lessons. First, how temporary sectoral reallocations can have very large aggregate effects. And second, a little study channel for policy transmission was very important in the policy response, namely the effect on both demand and supply of firms' cash flows. So let me elaborate on that. The first large effects from sectoral reallocations is, of course, not new, but it wasn't as present in the debate until COVID. The key economic feature of this crisis has been its unevenness. It affected some sectors far more than others. Big picture, we saw an enormous rotation in demand away from consumer-facing services and towards goods sectors. This increase in demand for goods ran up against supply capacity constraints and transport disruptions that caused a very sharp increase in good prices. And this increase in good prices was not matched by commensurate falls in services nominal prices because of downward nominal or price rigidity. So these very large reallocations with very large effects on relative prices can be inflationary in the short term. This large rotation in demand has reversed now in many countries, but the story in the US, which is the most important from the perspective of global goods demand, is a little different. The fiscal boost in the US has been larger than in other advanced economies, and this caused an absolute increase in goods spending that was far larger than in other economies. On top, of course, of the relative rotation. And in addition, the re-rotation back to services has been much slower in the US than in other advanced economies, certainly in the UK, for example, where we are almost back to normal. So bottom line, it's imperative to understand these global sectoral reallocations. From the UK perspective, it wasn't so much about the domestic reallocation, but really about this global phenomenon and understanding how this increasing US demand for goods meeting restricted supply push up on tradable goods prices, of which the UK is a net importer, had a big effect on the economy. The second lesson is an important role for policy of corporate cash flows. When there is such a large fall in spending. The initial health response consisted of closures of firms or even entire sectors driven by either mandated or voluntary social distancing. Absent cash flow support, many firms that had viable business models before COVID and were perfectly solvent would have been compelled to close down for good. And this would have left scarring in the economy and hysteresis, affecting the future supply of capacity of the economy beyond the acute phases of the crisis. So cash flows and policies that support cash flows during this deep crisis are important to prevent sustained falls in supply. But let me just say one thing about reacting to what Hanno said, how we got here. I mean, it's not that we like inflation. I mean, it's that we have been shocked by the biggest shock imaginable, because not only was the pandemic, but then there was the build-up to the war itself, and new waves of COVID affecting supply in many parts of the world. So clearly, this is an unprecedented period in terms of the shocks. And models, they don't predict shocks. This is why they're called shocks. And these are not anticipated. These are deviations from the model, from the models. And I think that's a big part of the story. But I agree with Hanno on the essence that our models can be improved. And I think one lesson, which is the one I'm emphasizing here, is that opening up and not working with an aggregate output, but rather looking at the sectoral composition is very, very important to understand inflation dynamics and the evolution of activity.
Okay, so we're inching towards a comprehensive sort of analysis of the recent trends. We've had some drift in central bank thinking, possibly some mistakes about our style, but an enormous churn and rotation in the supply side of the economy, as well as clear sectoral impacts that are working their way through to add to inflationary pressure. Some discussion that this might be unprecedented. I question whether it's unprecedented. We can find examples from the past that might match the current circumstances to some degree. But I wonder, and maybe I'll start with you, Ricardo, is that a sufficient set of explanations for the current inflation overshoot that we're seeing, or is there something else been going on as well?
I think there certainly may be more things, and none of us was trying to be exhaustive.
Yeah.
I think when we look at the causes of the inflation right now, let me anticipate right away, even as that debate is starting, there's going to be, I think, fundamentally three camps.
Okay.
And when I say three camps, I mean because it's going to be hard to reject either of them, and one can take three perspectives. Perspective number one, there were lots of bad shocks, unprecedented shocks, nothing we could do about it, inflation went up. I think there's certainly a lot of truth to that. However, our institutional regime of the last 25 years, which I understand as independent central banks with an inflation target controlling interest rates, is predicated on the belief that the central bank can offset shocks and keep inflation in control. It may not wish to do so, because it may want to trade off inflation with other parts of dual mandate, but it can do so. I like the analogy where if you ask whether my head got wet in a typical London day, not the atypical one like today, certainly the shock of whether it's raining or not matters, but I have an umbrella, and I either chose to open it or not open it, in whether my head got wet and my hair got wet or not. In other words, there are shocks, but there's also policy responses to it. Now, I therefore, on this first camp, on the it was only shocks, I think it avoids the question of, but why did we not respond in certain ways? And it may just be that we could not respond, it was really very hard. But if you go too far in the it was shocks, then you ask, then why did you control inflation for 20 years, and why do we admire independent central banks so much? Well, maybe it's just because you got lucky and you had good shocks, so you really don't deserve any of the credit of all the central bankers writing autobiographies about how they saved the world and kept inflation in control. As well as, moreover, then, are we going to have inflation in control the next 5 years? Well, who knows? Tell me what the shocks are. So then the whole edifice of inflation targeting central banks gets at least a little questioned. But that's, I think, one camp. Camp number two, we got lucky in a different way. The current regime was unsustainable. Inflation targeting central banks, really, it's all driven, let me give an alternative, by fiscal policy. Fiscal concerns ultimately drive inflation, as in fiscalists or fiscal theory of the price levels. And then it just happened in the last 20 years. It was a coincidence that we had inflation targeting and independent central banks delivering inflation. Maybe, again, I can't reject that. I think there's reasonable views to see that. We're going to see in the next few years. I tend to think that's not the case. I don't think it was a coincidence. But you would say that it was really the shift in fiscal with the increase in debt, the pandemic, that has led to this. Then there's a third camp, which would say, no, the way we think about monetary policy in modern models is correct. In terms of Taylor rule, independent central banks can control it. Yes, there are shocks, but one can respond to them. It's just that we maybe used models that could have been improved, misestimated states of the economy, made some mistakes in there, or made proper choices that said, given the very strange set of shocks, the optimal response was to let inflation rise to 8% or 9%, as long as it's very temporary and it will be brought down. I'm much more on this third camp. I think, in a sense, central banks allowed inflation to go up because they thought it was the right choice to do, subject to, of course, control. I mean, allowed meaning, I don't mean literally to the point. And so I tend to go on the third point, but maybe I'm just showing my conservatism in thinking that the last 25 years were indeed a golden age of central banking that will deliver, and fine, there were some issues now, but that we will fix. So I think ultimately I would say Jagjit is on these three camps. And here I'm trying to be much broader, following your question. I think then you can put different arguments here, and for sure it's going to mix some form of mix of all three. But I think more important is the debate on which ones these are, because I think that will determine the extent to which we want to change over the next 5 years the policy regime we've had.
Yep.
I think that the policy regime of inflation targeting, dependent central banks, setting interest rates, is the best one we've ever had. I think it's a very successful regime. I look at the last 20 years and think it was in response to shocks, good policies. Fundamentally, that was fine. I think we'll go back to that. And I look at the last 12 months as a mix of some misdiagnosis, some mistakes, data revisions, difficulties, combination of models, shocks that were unprecedented, some response to those, but that will be answered in the next few years.
Thank you very much, Ricardo. Silvana, when we met and discussed some of your work at the Dow lecture earlier this year, it was clear, not only from your work but others, that central banks in principle could have responded in a way to stamp on the inflation that we saw, but it was also clear that had they decided to do that, it would have led to tremendous output volatility and loss of employment and an increase in unemployment that, I speak from my perspective, may well have been inequitable given the COVID crisis that many of us had lived through and the impact on those in more precarious jobs. So I don't have to revisit that debate particularly, but is this kind of analysis one that you still subscribe to, that we're seeing a period of overshoot that it is right to smooth and look through wherever possible rather than responding to fully?
Okay, so I'm going to speak from the perspective of an IPC member.
Of course.
So we have a clear remit, and the remit says, asks us to get inflation under 2% target. But the remit is also clear that, one, at times inflation may depart from the target temporarily in response to shocks, and two, when large or persistent shocks create a trade-off between inflation and output stabilization, we need to balance that trade-off subject to returning inflation to target in the medium term. And the medium term is understood as the policy horizon of 2 to 3 years. So that's what our remit says, and at all times we've been setting policy in line with that remit, which has been framing the decisions. Now, both of these things happened. We have been hit by new, very large shocks, which we didn't know about when we were setting policy 1 year or 2 years ago. And we have also faced a very large trade-off, as you said, Jagjit, such that even if we had known about those shocks, perfectly offsetting their inflationary impact so as to hit the 2% target this year would have generated an enormous recession, and most important, medium-term inflation would have been below the target. So the clearest example of a new shock is the large increase in energy and commodity prices that we have seen. Commodity prices, commodity price fluctuations are very volatile and unpredictable at the best of times, let alone when they are driven by a war, as was the case with the most recent step up in prices. And so for that reason, we at the Bank of England don't try to predict those prices in our forecast. We condition on a broadly flat path for energy and commodity prices. So these movements are a new shock. And again, repeating what I said, our models are not trying to predict shocks. What they help us with is to understand how those shocks propagate through the economy once they have happened. And with that, we can, it can help us with our monetary policy decisions. Now, the rise in energy prices added, of course, to the inflationary pressures coming from other shocks caused by COVID, and specifically this uneven recovery of demand, slow re-rotation back to services, which have kept these tradable goods prices really high throughout this period. Again, we were not trying to predict COVID, because the evolution of it depended on virus mutations and the responses of governments around the world. We were trying to respond the best we could to return inflation to target, to the 2% target, again in the medium term. So in sum, we have faced very large shocks, and we need to respond them. This is our role by bringing them inflation to target in our policy horizon. Now, but to add to that, and Jagjit, you were referring to that in my speech back in February, I asked the hypothetical question. Suppose we had known in advance that these shocks were all going to happen. What would it have taken for monetary policy to achieve the target early this year? And the answer was an enormous tightening of monetary policy in the middle of the pandemic, which would have taken unemployment into 2 digits. So that was the trade-off. And this isn't a question of, okay, should we have raised rates a little earlier, November, December, or even 6 months earlier. That's not the question. That wouldn't have much of a difference for the peak of inflation that we're seeing now in most advanced economies. It would have shaped just a few basis points. And importantly, anything that would have made a material difference for that peak would have meant inflation well below target in the medium term, again, against our remit. So even if it had been possible to predict the perfect evolution of the pandemic, energy prices, the build-up to the war itself, the international policy response to the war, and so on, I would not have seen it in line with our remit to have struck a materially different trade-off in response to what is largely, in essence, a temporary shock. For me, any serious case for a substantially different policy has to address the trade-off. How much more unemployment would have been required during the pandemic? Within that, how would that have played out when you have, in the case of the UK, a furlough scheme which was designed to prevent unemployment? So it meant that the monetary policy mechanism wouldn't have worked as always because you couldn't generate unemployment, which in turn is what feeds into lower wages and domestic price pressures. But more importantly, what would have been the effect on medium-term inflation if you had offset that peak through a massive recession? So I think, these are important questions, and obviously, it's a difficult time for everyone, but we have to acknowledge the sort of the challenge that we're going through. These shocks these are not small disturbances in the models. These are really unprecedented.
They're certainly huge shocks, absolutely, and it's very helpful to have that thought process worked out, both in real time as you approached it, but also to imagine as if we did actually know the future, which we can never know what we might have done. I think it's a very helpful exercise.
Let me add to that, that it's important, the quantitative question, because you can always say, oh, you could have tightened earlier or a little bit more. So give me the numbers, and then we can compare notes.
That I understand. Thank you very much. Hanno, I wonder if I could ask your perspective on how the Fed has approached this same issue. To what extent, we've already heard that obviously it plays a critical role in global monetary conditions. To what extent is it more culpable than what we might think of as a semi-small open economy?
Right. Well, obviously the U.S. is extremely important. If I were to single out one actor, though, in the U.S., I would single out first the federal government. As Silvana pointed out, they spent more than a fifth of GDP. They weren't very careful about targeting their spending. That's partly because the transfer payment system is not as well developed in the US as it is in Europe, so it's just hard to get the money to the people who need it, but they didn't really try. And I think there's little question that 1.9 trillion package, the last one, was probably enough to tip output over potential output. And the fact that inflation subsequently went up in the rest of the world, that doesn't absolve the US, obviously. That's like saying if an elephant and a mouse jump in a pool, that they're equally culpable. Obviously, the U.S. Deserves a big share of the blame there. I think there was a lot of fiscal stimulus applied. But then the question is, why did the federal government think that they could just spend a fifth of GDP, whereas in Europe, most countries spent less than half of that? Well, I think it's partly the transfer payment system. But, and this is where I'm going to get to Ricardo's R* point, I think it's partly because a message has been sent by central bankers that R* is just extremely low, permanently low, and I think some people in academia have also sent that message. We're in this new era of permanently low real interest rates, and a signal's been sent to governments that they can go ahead and spend, and that their fiscal capacity may in fact be unlimited. I don't think that those predictions will stand the test of time. I think we'll come to realize that fiscal capacity is actually extremely limited. But I do think that those messages have made governments more willing to spend and less careful. And I think in the US we were particularly careless. The federal government was handing out money to states who subsequently used it for tax cuts. So, but to your point, I think the Federal Reserve, in sending this message, I think the new R* estimate now that they arrived at just before the pandemic is 0.5%. So you're telling people that the equilibrium real interest rate at the short end of the maturity spectrum is 50 basis points, and that they can sort of bank on that. That's, I think, in retrospect, that wasn't necessarily the right message. Why not? Well, first of all, what you're looking at is your own shadow if you're the Federal Reserve, because of the decade preceding this, what they've been doing is really drastically interfering in fixed income markets, not just a little bit, right? I mean, to remind people, for example, during the pandemic, the Fed bought more than issuance if you exclude T-bills. The ECB has done something quite similar. So these are not small interventions. That makes it awfully hard to know what R* is. If you're looking back, you're looking at a moving average of what you've been doing. You can use all sorts of Kalman filters, but you're really tracing out your own shadow. And I think what we've seen in the past couple of months is that when the Fed signals that they're going to take their foot off the pedal, then real rates go up quite a bit. And so one lesson I've learned from this is that central bankers aren't very good at really figuring out where these valuations, especially of longer maturity assets, where these are, because they've been really putting their finger on the scale in a big way. And that's part of the danger of quantitative easing. At some point, I think, you lose track of what the market's thinking and where their marginal valuations are. And then when you pull back, you see that, for example, the 10-year TIPS yield in a few months went up by 180 basis points in the US, 200 basis points in Germany. They've come down a little bit now. But those are, by any standard, drastic movements.
Just a follow-up, if I may, and then I'll actually go into the next topic, but I'll allow you to answer first, and then we'll go around. But to what extent has the inflation averaging regime contributed to the problems and interacted with fiscal policy to make things worse in the US, or do you think that's not been terribly important?
Well, I think it is important in the sense that, and actually Tom Sargent wrote an op-ed on this topic in the Wall Street Journal a couple of weeks ago, in the sense that before, the idea was basically to act preemptively. If you thought that inflation was going to be a problem, you would step on the brakes, and clearly that's not what they did in this case. I think that is consistent with the idea of average inflation targeting. I have to confess that I don't completely understand exactly what they have in mind, because they haven't been super clear about what it is they have in mind. But certainly, again, in retrospect, and I should say, by the way, we have a saying in Dutch that the best sailors are always on the shore, and I'm definitely one of those sailors. So you should take everything I say with a grain of salt here. But I do think that in retrospect, that probably wasn't a great policy change.
Yeah. So related to your point about the huge interventions in QE, and they've been similar in this country, some 35% of GDP is held as bonds at the asset purchase facility. To what extent has this blurred, in an unhelpful way, the lines between monetary and fiscal policy? It just seems to me, listening to you, and Ricardo in particular, there seems to be some interaction that's making it very hard to get us into the right space because of what fiscal policy has done, knowing what monetary policy will do and what monetary policy has had to do to try and help the fiscal policy makers. Are we in the wrong subspace now?
Oh, I think so, most definitely. I think the best example of this is the Eurozone.
Right.
I think the ECB has probably painted itself into a bit of a corner because now that they've signaled that they want to end quantitative easing, they've seen interest rates go up quite dramatically in some of the peripheral countries. And that, of course, presents them with a dilemma because they understand that interest rates where they are now, that's completely inappropriate given where inflation is, right? If you use some sort of Taylor rule, I know I sound old-fashioned when I talk about Taylor rules, but if you were to use a Taylor rule for the Eurozone, you'd probably say interest rates have to be somewhere, is it 700 basis points higher? And that's not very likely. But even before we've started to really raise rates, you see interest rates in the periphery go up. Now, of course, that's not surprising because the ECB has signaled to Eurozone governments that they had their back. And they've provided easy financing for these governments. And these governments have acted on that, as I would do the same thing if I was a politician. That's not a huge puzzle. And so now, of course, the problem is, where does the ECB go from here? That's not at all clear. They try to muddy the waters, in my view, by talking about fragmentation. I don't really understand what they mean by that. Look, you know, if you have claims to cash flows with different risk characteristics, they're going to trade at very different prices. The notion that the market's wrong and that the ECB is going to have to step in and correct these market misperceptions, that seems like a huge stretch to me. Central bankers don't have a great track record of correcting market valuations. That tends not to work. And so, honestly, I think they have gotten themselves into a bit of trouble there. Yeah, I hope I'm wrong about that, by the way, because I'm a firm believer in the European project.
We all hope, but nobody wants to see further disasters, that's clear. Ricardo, anything add on the monetary fiscal mix or the interaction between monetary fiscal policy having been blurred in a really difficult way in the last decade or so?
Let me add 2 points going back to a previous discussion on whether central banks were behind the curve or not. And I'll comment on the Fed and ECB, not the Bank of England. But I think the Fed, it is my view, and I think if one looks ex post of the data, was somewhere like 6 months behind in raising interest rates and tightening policy. I think just the fact that they're doing it so quickly now is as much as an admission, and that's the case. I think history will say that we may disagree, but whether it was 4 months or 8 months, but certainly 6 months in starting to tighten it. Why was that? Many reasons. We've already talked about some of the shocks and so on, and the reactively versus proactively. But it was certainly, I mean, as part of the discussion, it wasn't that long ago, so I remember it a little bit, was the fact that there was this perception that first, there was a sequencing of policy. First, you announce that you're going to stop QE. Then you actually stop QE. Then you start QT and raise rates. But you have to follow that sequence. But of course, whenever you want to stop QE, you worry how the markets will react. And so you hesitate for at least a couple of policy rounds. And this QE seemed to serve as a constraint to raising rates faster that was responsible for maybe a couple of months, maybe even 3 months, that is half of the delay that the Fed did. So here's an example in which QE did seem to constrain things. My own view is that I do not see why one has to follow the sequencing act. I see no reason why I can't raise interest rates aggressively, even as I'm doing QE per se, insofar as QE is operating on the length of the yield curve, and after 10 years, and insofar as tightening policy to fight inflation comes exactly with inverting the yield curve, having short-term rates rise very fast, even relative to long rates. So I don't see why we had to even stop QE, and this is especially present when it comes to the euro area. But it did play an important role in doing so. Second, when it looks at the ECB, which is how far is it, how delayed it is, to be seen since they haven't raised rates yet. So I think we're going at least 5 to 6 months now, maybe more, since it won't be aggressive. And there comes some of the issues that Hanno was raising, which is a real fear of fiscal dominance, a real fear that a much too fast increase in interest rates would cause a sovereign debt crisis. I think that's a legitimate fear. In no way should I say that one should not be worried about that. But it is, let's call the bull by its name, it is fiscal dominance. If you're afraid, if you see if inflation is 8%, you're now raising interest rates because you're afraid of what that will do to a sovereign debt market, that has a name in economics. It's called fiscal dominance. And the extent to which that is still a work in progress, and indeed they haven't raised interest rates, having to do with, no, first we're going to announce what to do about rates, how to combine stopping in QE with buying at different rates. It's clear that this has served as a constraint to raising interest rates. There's many other dimensions of fiscal monetary interactions. I've written about them, but just to keep it short, at least in these two, it does seem that QE led to a delay in raising rates in a way that, at least given inflation, was, in my view, undesirable.
Thank you, Ricardo. Would you like to add anything on monetary fiscal interactions?
Yeah,
and where
on
we
the
sit?
blurred lines, which was your original
Yes.
question. I think we have again to acknowledge that we're both fiscal and monetary policy, we're responding to the same shock, a huge pandemic shock, and it's natural that they would move in the same direction, and that got many people confused. Okay, is QE happening when the fiscal expansion is happening? Yes, because they were both responding to a common shock, and that's what we teach. Monetary and fiscal policy try to offset these shocks, and it's natural that they move together. So the blurred lines, I think now when the unblurring will show up, because monetary policy, certainly in this country, has been tightening. The QE portfolio has been shrinking, and so there's a clear split there in the movements. So on QE more generally, the way I see it, the main channel through which QE affected the UK economy during the pandemic has been through the liquidity channel, offsetting market disruptions, particularly in the March 2020 episode. And then subsequent rounds were helpful in preventing a recurrence of those episodes as new COVID waves struck and there were more supply issues popping up. So in that sense, given that the role of QE has been mostly in offsetting liquidity disruptions and preventing further liquidity disruptions, I would expect the effect of the unwind of QT in the UK, to not have a material impact on the economy. And so far, our experience with the beginning of the shrinking of the portfolio is consistent with that. But obviously, I mean, QE here has been different from other districts.
So just to follow up, so you see QT proceeding as a runoff over time?
So, well, as we
there'll be a
said,
report coming out next month.
right, so we will be in in August 2021, in the monetary policy report, we already said that we expect bank rate to remain the main instrument to determine the policy stance. And we would expect, again, any QT that happens gradually and predictably in well-functioning markets to have a smaller effect than QE. And I think that's the basis of the thinking. We haven't decided on the unwind yet, but that's what we are studying now.
Thank you. I look forward to that further. Just briefly, and then we'll turn to the floor. How do you see QT working its way through in either of the ECB or at the Fed? In a similar way as a runoff, but the bank is going to be publishing its new thinking, I think, next month.
I'm going to come back to the fiscal constraints there. I do think that the fiscal constraints are real even in the US. So if you use the analogy of the 1980s, so when Volcker came in, hopefully this is not a recurrence of the Volcker episode, but when Volcker came in, and he dramatically raised real rates, obviously. And the thing to realize is that when he did this, the debt to GDP ratio in the US was 25%, and the US was running primary surpluses. The debt to GDP ratio now, we've talked about, is well above 100%. If you were to raise R above G persistently, even 100 basis points, that would be extremely costly. And I do think that we have to at least consider the possibility that the reason the Fed, even back in March of 2022, was still projecting real rates for the next 2 years below 50 basis points. Some people call this the immaculate disinflation hypothesis. I think that might partly reflect the fact that people on the FOMC understand that there would be a lot of pain involved if they raised real rates dramatically, given the fiscal situation. I think this is a slow-moving state variable. Well, it wasn't slow-moving in the past 2 years, but it typically is, and it looks very different from where it was in the 80s. So you could ask yourself, could Powell do what Volcker did? And I'd say that's not so clear. That would be extremely painful.
No, it'd be very unlikely for Powell to do what Volcker did, even without that situation, I suspect.
Yeah, I agree with that. Yeah.
Let me push in the opposite direction, also to make the panel more interesting.
Yeah.
But talking about Europe.
Yeah.
Italy. Let me talk about Italy. Debt to GDP is 150%.
170.
150, 150.3, I think.
Are you sure?
Yep, 150% is debt to GDP in Italy. 150%, imagine, but only a third of that is due in the next 2 years, approximately. So roughly 50% of GDP. Imagine the ECB raises to fight current inflation interest rates by 300 basis points. Why 300 basis points? Because that's more or less what I think is right. Don't ask me why. Let's go with 300 basis points. 300 basis points over 50% of debt coming due in the next 2 years means that you will have at most an increase in 1.5% in your interest spending. It's much less than that, because some of the debt coming due in the next 2 years was borrowed 10 years ago, where interest was actually much higher than the plus 300 basis points that you would add now. So upper bound, this is going to cost Italy 1.5% over 2 years, where I'm saying 300 basis points over 2 years may be just enough to bring inflation back under control. That seems pain, again. I don't think I'm too far off with 3-4% GDP. But Italy, this year, is benefiting in its 150% of debt to GDP with the fact that the GDP deflator is going to be something like 6 to 7% higher and probably another 4 next year. That means that over these 2 years, Italy will have inflated something like 10% of GDP of its debt. So I'm asking, me, the inflation hawk in the panel, if you want, who wants to control inflation, wants the ECB to go to 300 basis points. I'm asking, give me 3 percentage points of GDP. You've benefited from 10% from the high inflation. I struggle to see why concerns with the Italian debt, purely on fundamentals, would stop us from raising interest rates to lower inflation, which seems to be very much a sticking point in the debate in Europe. Of course, I understand that there's multiple equilibrium. Absolutely, I can understand more. But hold on, if you're going to tell me multiple equilibrium is a reason not to raise rates, not to control inflation, I will throw back at you multiple equilibrium and say, if you don't raise rates and inflation expectations go high, then the multiple equilibrium is that we think that interest rates on Italy at 10 years are 7%, and then we're back to the 1980s, and we'll have 3% debt GDP or unsustainable. So the discussion that seems to have gripped so much of the ECB that raising interest rates is absolutely not will throw Italy into default doesn't completely fit the fundamentals as I measure them. And when you go to multiple equilibrium, then we're welcome to tell stories in different ways. So slightly different perspective than the one Hanno was giving, without rejecting, but just very focused on Italy and why this aversion to fight inflation for fiscal concerns may be a little exaggerated sometimes.
Very good. Very helpful to have that interaction. So we have some questions. We'll collect 3 questions perhaps. I can see 3 hands up. Wonderful. That's a good match. Man in blue, Michael.
And the blue.
Yeah, I didn't get the memo of dressing up for today.
Yeah, I forgot. I mean,
that's okay. Academics. Michael McMahon, University of Oxford. I wanted to sort of follow on a little bit from Ricardo's last point and sort of flip the theme of the panel. What would the advice be? And maybe Silvana, you can excuse yourself as you're listed as a Bank of England person here. But what would the advice of the panel be to fiscal authorities right now in an environment where potentially Ricardo's right, the central banks are going to have to raise rates 300, maybe more, depending on what goes on. But in a world where they both face this rising populism and the cost of inflation being disproportionately on poor sections of society, they've shown in the last 2 years they can take large fiscal actions to address such inequalities, and they were willing to do it. And yet they face these sort of slow-moving, iceberg-like challenges of climate and demographics that are coming 20, 30 years down the road. I say this, I was going to ask your advice for the Chancellor of the Exchequer. The UK no longer has a Chancellor of the Exchequer because Rishi Sunak has just resigned. But for other countries that do have Chancellors of the Exchequer, what would your advice to them be?
Well, does that mean I can go back to the office now? Well, goodness me, I feel okay. I've been hiding for 3 weeks. Right, that's a great question. Can we just collect up the other two, and we'll get Gulcin in as well, please.
Thank you very much. I'm Broggio Cesabianchi from the Bank of England. I have a question about R-Star that we've been talking about, and I'd like to get the views from the panelists on if we were to kind of look through what we think about temporary shocks, is the risk of higher R-Star that we discussed something that you see as a high probability risk of having higher interest rates in equilibrium? Basically, I'm asking you to do a trend cycle decomposition, really. And, it's a dangerous business, but, if we were to exclude the cycle, and if we think about, all the factors that, at least in the academic world, have pushed down on R-Star, things like demographics, a slowdown in productivity, inequality, or the rise of risk premia, which have tended, or at least that's the way in which we think about the secular fall in R-Star in past decades, those factors to me don't seem to be pushing towards kind of a balance of risk that is on R-Star going high. So once we exclude temporary things, the question is, do we still believe R-Star, there is a material risk of R-Star, the trend component of R-Star, to be higher? Thank you.
Take two more questions because I've been told we have to finish shortly. There are prizes to give out to young people, and that's the most important thing of all, it seems to me. We don't want to miss that. And then we'll go to Gulcin for the final question. We'll see if we get there in time. Please go ahead.
Yes, George Selgin from Cato. I have a quick question, mainly for Ricardo, but also for the other panelists, if they'd like to opine on it. And that is whether you think among those factors that may have delayed the Fed in raising rates, the pronouncements made by several Fed officials during the COVID crisis to the effect that they didn't expect to raise rates till 2023 or even 2024 may also have been a factor. That's one question. And the other, it concerns what I see as a kind of elephant in the room. Full disclosure, I'm an NGDP targeting fan, but hearing Ricardo comment on how central banks can't easily blame real shocks forever so long as they've got inflation targeting frameworks that they're committed to. And yet you said that you see inflation targeting, that regime, as the best we've ever had. Silvana, on the other hand, spoke of the important exceptions that the Bank of England has had to make to its 2% inflation targeting remit. And my question is, what about NGDP targeting, which automatically would have central banks see through real shocks and their effects on the price level, and would be a framework that, if it were adopted and explained, would relieve them of the duty to try to suppress inflation when it stems from real shocks? If that's an important qualifier, if it could be explained to everybody.
Thank you, George.
So of course, that's important.
Thank you, George. We'll just collect one more question, and then we'll sort of, you can pick whichever one you want. It'll be fine. Gulcin.
Thanks, Jagjit. Gulcin Özkan, King's Business School. I'm changing the focus of this conversation a little bit and would like to ask you about climate policy. So I think we are at an unprecedented point in more ways than one, and we are at a cusp of adopting a new policy. There's almost near consensus, not just in advanced economies, but also in emerging economies, that we need now this climate action. So in one way, this changes the way we follow expansionary policy. We can't without worrying about potential for climate, but it might also provide possibilities, much talked about, green investment and as engine of growth for going forward. So my question is, at this particular point in time, do you see this as a challenge or an opportunity?
Thank you very much, Gulcin. I I think one thread running through those questions is in a sense, the central bank's remit. I suspect some concordance on this panel about inflation targetry. But the questions here were really about, should the remit be broadened? Do we have to take into account other considerations? Should we drop it altogether, go to nominal GDP targeting? How can we encompass the correct move to a green agenda, but within the context of continuing to focus on price stability? Seems to be that kind of sense emerging from the questions, as well as the questions on R-star itself. So I think rather than me directing you to answer, we have an idea of what people want to hear us answer. Perhaps I could just leave you to decide which parts of those questions.
So if I can start from the
first.
Yeah.
Yes.
So I think climate change is obviously the biggest threat we face for livelihoods and lives. But this is a problem for governments, not for central banks, in my view. Obviously, central banks need to be really tuned on, and because we will be facing more recurrent weather-related events, and we need to understand the risks involved, and so on and so forth. From the perspective, and here I'm speaking mostly from the perspective of the Monetary Policy Committee. Obviously, financial policy has a different mandate. But for us, again, we have very few tools, and our primary focus is price stability. The remit guides us when we face shocks that put us in trade-off territory with activity and employment, and on how to return inflation to the 2% target. The remit also asks us to pay attention to climate considerations, and in some sense we do, but it's a very small part of the package. I mean, in our particular case, it enters in the composition of the portfolio of corporate bonds, which is a tiny part of the QE package, really. So we, from the Monetary Policy Committee, certainly are not going to do much to help with the climate problem, which is huge. But I like to stress what Ambrogio said about structural R-star or trend R-star. I think that the structural factors that have pushed down on R-star, as you mentioned, Ambrogio, demographics, lower productivity growth, inequality, incidence of tail risks, they have not gone away, and so that's why I think, trend-wise, that R-star has not changed. Obviously, in the short run, the equilibrium R-star, small R-star, might be higher. But the other issue that I think sometimes people don't realize that it's not that we have this idea of, okay, this is the capital R-star and the short R-star, and we don't look at anything else, and we just go by the star variables. No, we are looking at variables that directly inform us about what are the inflationary pressures. So we are looking at domestically generated measures of inflation, and this gives us a hint of where things have moved, at least in the short run. Again, for the long run, I don't have any reason to believe that the R-star trend has changed materially with the pandemic or even the war. But clearly, the short run equilibrium interest rate could have, may have changed. But again, it's not a dominant factor in the thinking. We have so many other variables we're looking at that indirectly speak to those tensions. So.
Thank you, Silvana. Ricardo.
Quickly, let me start with exactly with the R-star just to follow up. I think an underappreciated fact, but one that I hope gets more attention, is that if you look at the returns on capital, either measured directly through national income and product accounts, or if you look at the returns in financial markets at the right margins, BBB corporate bonds, equity including private and venture capital, what you find, and you do this not just for the United States or the UK, but for 30 OECD countries. And I say if, because I've done it, by the way, so I'm about to tell you the answer. What you find is that R-star, and I mean the R-star that comes out of the Ramsey model, the R-star that's the heart of the DSG models that you write, Ambrogio, and I write, the marginal product of capital, the returns on private investment in the economy, has been completely flat for 20 years. So the so-called fall in R-star, which has perhaps been over-explained by appealing to demographics and productivity, is entirely a government bond phenomenon. in, like Hanno was pointing, and I'll borrow a little bit from him, in a time in which government bonds have been in a particular strange couple of decades, in the last decade with the intervention of central banks, as well as, strangely, with a successful inflation targeting regime that removed for countries like the US and the UK, in which sovereign default, let's say it's very remote, entirely all inflation risk, therefore making government bonds extremely safe. And at a time also in which we've had very large changes in financial regulation that have increased the demand for government bonds for collateral and other things, especially following the global financial crisis. So you ask for a reversal of why our star would go up, but I would reframe it as, will the spread between the R star in private investment and the R star in government bonds revert or not? And I therefore look at factors not like demographics or productivity, but rather to what has made government bonds special. Why will they stop being special? And boy, the fact that government debt GDP is so much higher, that central banks may stop doing QE, the fact that financial and the fact that, especially given the topic of this panel, that inflation risk may be back persistently as opposed to not temporarily, may all, yes, lead me to expect that the gap between the two R stars will have changed. And therefore, while I won't be as bold as forecast permanent temporary decompositions, I will say that I am not confident that the government bond R star, the one that matters for public finances, the one that constrains policy actions, may yet indeed be rising, even as the R star that's relevant for transmission of monetary policy, that's relevant for investment decisions, continues to stay flat as a response of non-changing demographics or productivity. So I would draw a very, very strong distinction between those two. And I would think that the factors that you meant that are slow moving affect the other R star, not the R star that the mission reviews are about, and so on. I've called it M in some of my previous work, but that's a terrible, because everyone tells me that's like money.
Yeah, I agree with that. I think actually,
it's different R's.
Yeah, a great country to look at, by the way, if you're skeptical, is Japan. In Japan, actually, the only buyer for long-term government bonds, you can look at the flow of funds to verify this, is the Bank of Japan. Private investors have been selling since 2015. So the notion that you would take those yields to make inference about our star, you wouldn't want to do that, right? Because it's clear that that's not a market interest rate anymore. Private investors are no longer buying bonds at those prices. And I mean, of course, the regime we're in Europe and in the US is different from that in Japan, but Japan is, I think, just an extreme version. So I agree with Ricardo. I'm very skeptical about the low R star argument. I think to some extent the Fed and the ECB, maybe the Bank of England, are looking at their own shadow. Let's see what happens when we stop buying all those bonds. And I think government bonds will be less special, and interest rates will increase significantly, I think.
Let me answer quickly, George.
Please.
George, I was speaking about the current institutional regime in the last 25 years in a somewhat broader sense. Central bank independence with a nominal anchor, inflation target is the one that we've adopted, and with the use of interest rates as the main policy tool is, I think, what's delivered, and that's the institutional framework I was saying. I do not in any way want to say that we've reached nirvana or the optimum and that we can't improve over the one we've had. We should do mission reviews, change it. Is it better for the nominal anchor to be a strict inflation target, a core target, a forward-looking target, a nominal GDP target? I bundled all of those together in my answer, so I was not as extreme as I may have sounded. I was saying that regime, as opposed to, as I said, different regimes in which I'm thinking here of fiscal dominated, meaning central banks are no longer independent, where instead of a nominal anchor, we go to different, for instance, a monetary anchor, a gold anchor, a peg anchor, which I think is shown. But I'm showing here my lack of imagination by just looking at the past. But I would say NGDP is still within the what I call broad inflation targeting regime of the last 20 years, which I think has worked. And so I don't think I would abandon it. I would perfect it and discuss, should we really do nominal GDP or something else that's somewhat different. And then very quickly, just on Michael, so that he doesn't ignore it. We don't just talk about our star. Michael, ultimately, first, this issue of our star, which I'll repeat, which means that maybe the fiscal space is not the same as before. But there's a sense, it's quite striking the extent of permanent drift when you discuss this fiscal policy. We did something extraordinary 2 years ago in terms of sending checks to people to a very large extent, and now that seems to be what is expected, and any deviation from that is seen as something very terrible. We shouldn't be responding to all shocks by sending lots of checks to lots of people. That costs a lot, and at some point, there are fiscal limits, and I think we will sooner or later have to discover the fiscal limits. So in the end, the answer to your question is inevitably, if you think there are some limits, that at some point governments do have to use that evil word that's been banished from dictionaries that starts with an A and ends with a Y when it comes to fiscal policy. That was austerity, guys. Yeah. At some point, I mean, you do have to at some point run some surpluses. Not just at every crisis, more and more, this requires a deficit, that requires a deficit, that requires a deficit in an endless way. Especially because, and then finally on the last question, on climate, because I do think that indeed we need some serious investments. Those require fiscal commitments, but those do not mean deficits. I mean investments that are important that require payments and either raising taxes or at least cutting a lot of other government programs to make way for the very important public investments that are required towards climate change.
Yeah, but if I may, I sort of agree with Silvana. I don't want to mischaracterize what you said, so correct me if I'm not characterizing what you said. I don't think it's the job of central banks to fix the climate change problem. The ECB on Monday announced that they were going to decarbonize their corporate bond holdings. I don't think the ECB has a mandate for doing that. I think climate change is a real issue, and politicians have to address it. That's how democracies work. The ECB has a super narrow price stability mandate. I read it a couple of weeks ago. There's nothing in there about climate change. I read it very carefully. And that's very important, actually. That's the reason I come back to it. In a democracy, you cannot give agencies authority over issues over which they weren't explicitly given authority by voters, because they don't have a mandate from voters. So I think it's a very bad idea to go down this route, and I think that central banks who do that might, in the long run, actually pay a price for it in terms of their independence. So I'm actually, even though I think climate change, I agree with you, is one of the biggest challenges, I think we should force politicians to deal with it and not have central banks become the default responsible agency.
It shouldn't be the only game in town.
Excuse me?
They shouldn't be the only game in town.
They should not be. They don't have a mandate for it, and it's not their expertise, and I think
one thing
that's right. Yeah.
I would think we might believe in is having better politicians than we've currently got. But a lot of people argue you get the politicians you deserve. So it's a very...
well, that's true too.
This has been a wonderful panel. There was a recent book written on monetary policy, and the second paragraph wondered whether monetary policy was dull. Let me say the author of that book is an idiot. It's certainly not dull. I love the fact I think about monetary policy and meet experts in monetary policy. I think it's just as interesting and fascinating as people who decide to work on diplomacy or foreign policy or defence studies. It is an area of research that combines quantitative methods, qualitative methods, history, practice, policy, interaction with politicians. It is a worthy source of work for your life's work, and I think it's actually fascinating for me to have sat next to you three today. I've enjoyed every minute of it. I know the audience have as well, but I think it's appropriate for us simply to give our thanks in the right way. Thank you very much.
Thank you.
Ricardo, thank you very much. Excellent panel.
Thank you, Jagjit.
Not at all. Thank you.